Hi, today we're going to go over call options, but first a disclaimer. This is just for entertainment purposes only. There are several risks involving trading in the stock market, and you should always consult with a professional. With that said, let's begin. I personally use options in the stock market to maximize my gains. In this video, I'll show you how I do it. What are call options? First of all, options are contracts. Basically, it's a deal between the person who buys the option contract and the person who sells it. The option contract gives the buyer the right but not the obligation to buy a stock at a certain price. You should know each contract comes with an expiration date, a striking price. Also, each contract represents 100 shares of the underlying stock. A call option increases in value when the stock rises. A call option loses value when the stock moves lower, especially if the stock goes below the strike price. Let's use Apple as an example. Ticker symbol AAPL. Apple closed on Friday, September 18th at 175. Let's say I'm the buyer. As a buyer, I am given the option to buy Apple at $178 a share within the next 2 weeks. For me to have that option contract, I have to pay the seller $3. I'll actually be paying $300 per contract because each contract represents 100 shares. Is that a good deal? Well, it depends if the price of Apple stock goes up or down. Let's say I paid $300 for the call option, which gives me the right to buy Apple at $178, and it's valid for 2 weeks. Scenario number 1. This is how I win. Apple is currently sitting at 175, and within the next 2 weeks, Apple moves to 182. At that point, I will be making a good return on my option contract. The option contract I bought is a call option. With this contract, I bought the right to buy Apple at $178 within a 2-week period. If Apple moves to $182, I have the option to buy Apple at $178, which is a good deal because I would be buying Apple for $178 and immediately sell it for $182, making a $4 per share. Now let's look at how I can lose money on this trade. Each contract comes with a time window before the option contract expires. If the stock doesn't move to the upside during this time, preferably above the strike price, then my contract is likely to lose value to the point of being completely worthless by expiration date. In this new scenario, I buy the call option that gives me the right to buy Apple at $178 within the next 2 weeks. If during these 2 weeks, Apple stock is only trading at $178 or below, then that means my contract will expire worthless. The contract is worthless because everyone has the opportunity to buy shares of Apple at $178. Scenario number 3. If Apple goes to $178.50 within the next 2 weeks, that means the value of that contract will be worth about 50 cents on expiration day. Although it went above the strike price of $178 and there is a gain of 50 cents, I still lose because I paid $300 for the contract. So if I want to win, I need the stock to move quickly in my directional bias, in this case, to the upside. And the best way to do so is by having volatility. If Apple receives great news, it could potentially impact the stock in such a way that the stock moves higher and faster. Just like with stocks, I can buy and sell options in the same way. This means I don't have to exercise my right to buy the stock at a certain price. I can just sell the options contract. If the stock is above my strike price, I can certainly exercise the right to buy the stock at the predetermined price and hold on to it. At this point, my option contract will disappear from my account and I will end up with 100 shares of Apple. You can buy different strike prices, as you can see in this screen of options chain. The higher the strike price, the cheaper it is. mainly because there are less probabilities the stock will go to that price. Also, if you want more time in your contract, you're going to pay for that extra time. If I want to buy a call option, this is how I do it. I search for the stock, in this case Apple, and then I look for the option chain. Once I have the option chain open, I select the one I am interested in and I buy to open. If I already have the position in my portfolio and I want to close it, then I go and select sell to close. By now you know if a stock moves towards your directional bias, you can make good money. You also realize that if the stock price doesn't cooperate within a specific time window, then you lose money. If you found this video helpful, please give this video a like and share it with someone who can find this helpful. Thank you.